Good morning and welcome to TOI Japan Market Radio, December 20th, 2025. I'm your host coming to you from Tokyo, and this is your daily briefing for global investors tracking Japanese equities, currency, and rates. Joining me today is our portfolio manager focused on Japan macro strategy. Thanks for being here.
Thanks for having me. Before we dive into the key news, I should note that Japanese markets were actually closed today for a holiday, so we have no price action domestically to report. However, there's been significant policy development and global spillover that investors need to understand heading into the next trading session. The big story is the Bank of Japan's rate hike and the somewhat counterintuitive market reaction that followed.
Right, and that's exactly where I want to start. The Bank of Japan delivered a rate hike, but the yen weakened broadly across major currency pairs. That's not typically what you'd expect when a central bank raises rates. Walk us through what happened here.
It's a great question because on the surface it looks paradoxical. Normally rate hikes support currency strength, but the market reaction tells us investors are interpreting this move as either insufficient or signaling continued caution from the BOJ. There are three plausible explanations. First, traders may have been positioned for a larger or more aggressive hike and are now disappointed. Second, the hike itself might be read as acknowledgement that the economy remains fragile, requiring only modest normalization. Third, and I think most likely, the forward guidance probably emphasized gradualism rather than a hawkish pivot.
So the market is essentially saying the BOJ is still dovish relative to other central banks, particularly the Federal Reserve. What does this mean for Japanese equities when trading resumes?
Near term, I'd expect a modest tailwind for the Nikkei and TOPIX. A weaker yen is structurally positive for Japan's large export-oriented sectors like autos, semiconductors, and industrial machinery. These companies see improved overseas profit repatriation when the yen depreciates. However, domestically focused stocks could face some headwinds if the rate hike is interpreted as the start of a tightening cycle, even a gradual one. The balance probably tilts positive given Japan's export weight in the major indices.
And on the currency side, we're seeing yen weakness across the board. That's obviously a boon for exporters, but there are trade-offs.
Absolutely. The weaker yen does benefit exporters, but it also raises import costs, which feeds into inflation. For households and domestic consumers, that's a headwind. For policymakers at the BOJ, it complicates the inflation outlook because they're trying to achieve stable price growth, but yen depreciation can overshoot and create imported inflation rather than demand-driven inflation. It's a delicate balancing act.
What about Japanese government bond yields? How should investors be thinking about the JGB curve here?
I'd expect yields to rise modestly if the market starts pricing in a gradual tightening cycle. But the key word is gradual. The long end of the curve is likely to remain anchored because the BOJ has signaled it's not in a hurry to normalize policy relative to global peers. If anything, the yen weakness reinforces the idea that Japan is still in a different phase of the cycle compared to the US or Europe. So yields may drift higher, but I wouldn't expect a sharp steepening.
Staying with the global theme, we're also seeing positive momentum out of Asia more broadly. Asian shares are expected to rise following better than expected US CPI data, which lifted both stocks and bonds. How does this US inflation print matter for Japan specifically?
This is important because Japan's equity markets are highly sensitive to global risk appetite and US monetary policy expectations. When US CPI comes in softer than expected, it reduces the probability of aggressive Federal Reserve rate hikes, which has a cascade effect. Lower Fed rate expectations typically reduce the attractiveness of yen-carried trades, but they also improve global risk sentiment, which tends to benefit cyclical and export-heavy Japanese stocks. The net effect is usually positive for Japanese equities in a risk-on environment.
So we're looking at potential upside for the Nikkei and TOPIX when markets reopen, driven by this improved risk sentiment. Which sectors would you expect to outperform?
I'd focus on exporters and cyclicals. Autos, semiconductors, and machinery sectors typically do well when global risk appetite improves. These are also the sectors that benefit most from a weaker yen, so you're getting a double tailwind here. On the defensive side, I'd be a bit more cautious on utilities and domestically focused names, which tend to lag in risk-on environments.
And what about the yen itself in this context? Does the softer US CPI data put pressure on the dollar-yen pair?
It's a bit of a tug of war. On one hand, lower Fed rate expectations reduce the interest rate differential, which should support the yen. On the other hand, risk-on sentiment often pulls capital away from the yen as a safe haven asset. My expectation is modest yen weakness in the near term, but I'd watch for volatility because we're at a point where positioning can shift quickly. Any surprises in US data or BOJ communication could swing this pair materially.
Makes sense. Meanwhile, in corporate news, there's an interesting development in the semiconductor space. Nvidia's valuation has declined to a historic discount relative to the broader chip index, according to Bernstein. Why does this matter for Japan, given that Japan isn't a major player in chip design like Nvidia?
Japan may not design chips like Nvidia, but it's absolutely critical in the semiconductor supply chain. Companies like Tokyo Electron and Advantest are key suppliers of semiconductor equipment and testing tools. Japanese firms also dominate in chip materials and precision components. So when Nvidia's valuation compresses relative to peers, it signals potential shifts in capital expenditure priorities across the chip sector. If chipmakers start cutting capex or reallocating spending, that directly impacts demand for Japanese semiconductor equipment.
So there's a risk that this valuation compression for Nvidia could translate into weaker demand for Japanese semiconductor suppliers. How should equity investors be thinking about this?
I'd say it's a yellow flag rather than a red flag. The semiconductor equipment and materials subsectors are core constituents of the TOPIX, and they've had a strong run over the past few years driven by AI and data center demand. If that demand moderates, we could see some profit taking in those names. However, there's also a potential silver lining. If Nvidia-centric supply chains start to diversify, Japanese suppliers could gain share in alternative chip production, particularly for automotive and industrial applications where Japan is already strong.
What about the broader market implications? Does this Nvidia news shift sentiment for Japanese equities overall?
It depends on whether this is an isolated Nvidia story or a broader tech sector cooling. If it's the latter, we could see some risk-off sentiment that would typically strengthen the yen as a safe haven asset. That would be a modest headwind for Japanese exporters. On the JGB side, I'd expect minimal direct impact unless this triggers a broader risk-off move, in which case JGB demand could pick up and yields compress slightly.
Shifting back to the big picture, we've covered a lot today despite markets being closed. The BOJ rate hike and yen weakness, positive spillover from US CPI data, and some caution in the semiconductor space. How should global investors be positioning as we head into the year-end period?
I think the key takeaway is that Japan remains in a unique policy position relative to other major economies. The BOJ is tightening, but very gradually, and the market is skeptical about how far they'll go. That creates a supportive backdrop for equities, especially exporters, as long as global risk sentiment holds up. On the currency side, the yen is likely to remain under pressure, which is a tailwind for earnings but also a wildcard for inflation. And in fixed income, JGB yields are likely to drift higher but remain range-bound unless we get a major shift in BOJ communication.
So a constructive outlook overall, but with some key risks to monitor around policy divergence and global tech demand. For our listeners tracking Japan exposure, these are the themes to watch as we close out the year and move into 2026. If you're a global investor following Japanese markets, consider subscribing to TOI Japan Market Radio for your daily briefing. Thanks for joining us today.
Thanks for having me.